Investment advisory services offered through Arca Investment Management, LLC, a registered investment advisor. The subject matter discussed here is provided for general information and educational purposes and is in no way intended as an investment advice, investment research, legal advice, tax advice, a research report, or a recommendation. Any decision to invest or take any other action with respect to any investments or strategies discussed in this series may involve risks not discussed, and therefore such decisions should not be based solely on the information presented. Please consult your own financial, legal, tax professional. This discussion is not a solicitation or an offer to sell securities or investment advisory services.
Welcome to Connecting Nodes, a new podcast we are launching today where we aim to connect the world of investors and builders. What are the founders building today? Where is the innovation going? What potential new themes and trends are emerging? And for investors, what does the world of digital assets look like, not only today, but in 1, 3, 5, or even 10 years down the road? This is educational. These are obviously our points of view. We are extrapolating a lot of information and data, not only from our work. Michal and I both run our early stage venture fund, but also from the conversations we're having with founders and with builders around the world of digital assets. We look forward to sharing a lot of information. We'll try to make this fun. So in Q1 of 2023, from a venture perspective, majoritively early stage, Series A, maybe a few Series B, we wanted to give you a few data points here, and then we're going to talk about trends and we're going to talk about themes that we're seeing. But in Q1 of 2023, just get a recap here. So we have seen about 245 deals emerge over the last quarter. Roughly about $2 billion have been deployed into deals in this sector. This as a comparison to Q1 stats. Q1 in 2022, we saw 543 deals and roughly $14 billion deployed into deals. So this is a rather large redux of deal activity and capital flows. However, there's some good information in the data points here that we'll go through very quickly. In the last 3 months, in January, February, March of 2023, in January, we saw roughly 75 deals completed, roughly about $566 million invested. However, in February, we saw 97 deals completed for almost $900 million, roughly about $856 million. And then in March, we've now seen about 54 deals completed for about $480 million. I want to bring this as a point, though, because we are seeing a significant amount of capital flows relative to the last time we had quote-unquote crypto winter, where these numbers were magical compared to those years in 2019. Many people in the space couldn't even imagine these numbers back then. And so these numbers are representing some significant flows into infrastructure, for instance. That is an emergent trend in the sectors here in digital assets. Infrastructure is capturing the lion's share of deal flow and capital. In January, we saw 23 deals, roughly $327 million in infrastructure. And in February, we saw 22 deals, roughly $239 million of infrastructure. And in March, we saw 6 deals of $75 million going into infrastructure. So that is where we're seeing a lot of the inflows going. Now, before I go to Michal and talk on some of the trends and some of the capital formations and flows and valuations that we're seeing as well, too, I wanted to just outline February because, as I said, February was an outlier. We saw in January $566 million invested, and then in February we saw $856 million invested. And so there were a few things there in February that caught my eye when we were looking at data. There was one deal, Taurus, which raised $65 million in their Series B from Deutsche Bank, Pictet, and others. What is Taurus? They claim to be the leading digital asset infrastructure provider for financial institutions in Europe. They handle things like custody. They handle things like tokenization. And they also claim to have a regulated marketplace there as well, too. Why I call this out, and we're going to talk more about this later, is the emphasis on Europe. This is going to have a conversation we're going to have about regulatory impact that we have here in the United States and things around the world. So Taurus is very interesting. I think some of the investors in that were definitely very interesting to note. A few others very quickly here. Carbon Place raised $45 million from BNP Paribas, Bank of Tao, NatWest, and a group of other banks. What is it? A carbon credit transaction network which connects buyers and sellers through their banks. And they recognize as banks for a need for true collaboration between financial sector and other carbon marketplace participants to bring trust, transparency, and access to the voluntary carbon marketplace. The last one, Superplastic, raised $20 million in an extension round, and I bring this up only because some of the investors here are really interesting. Amazon Alexa's fund, Google, and Craft Ventures, plus more. And so this is a home of synthetic superstars, what they call Genki and Gugamon, and the world's premier creator of digital designer toys and apparel. So not only are we seeing some pretty big checks and pretty big rounds here in February, but we're seeing some fairly affluent investors, institutional investors, Deutsche Bank, Pictet, Google, Amazon Alexa. So there is significant institutional involvement still in this space. And with that, Michal, why don't you take us through some of the trends and themes that we're seeing?
Certainly trying to dig into the numbers a little bit more and kind of peer the curtain as to what might be driving some of those big delta and swings that we have seen from January, February back to March. Primarily, as we look at private markets deals, there is a significant element of lag that often isn't, frankly, talked much about. Some of the founders are very well aware of that. Many of the investors are. But to the public that perhaps is not in the day in, day out deal mode, that might be lost oftentimes on them. So what we have seen primarily in the private markets is that pretty significant lag of, I would call it anywhere between 2 to 3 quarters historically, this time around looking closer to 3 quarters behind where the liquid markets and kind of in the token world has been. Deals in particularly private markets have been following that pattern as well. And so not only the price volume of those transactions that has dipped, there is also another element, and I think something that David, you pointed out too, some of the rounds that have been completed, especially in Q1 of this year, tend to be actually a lot chunky, almost kind of a later stage of kind of the spectrum of the companies that we have seen. And with those primarily, and the names that you have listed of participating investors, we are actually seeing quite an incredible trend of how investing in digital assets infrastructure has no longer been carrying a lot of carrier risk for many of those investors, and especially investors that are seeing this as a future underpinning layer for a lot of the very well-known ways of selling products to the market in a form of digital assets and easing that access all the way to really retail-facing elements of engagement with digital assets in the examples of Superplastic you quoted. So I would kind of look back at what has happened in Q1 from kind of several lenses. One, real institutions actually taking a position and long-term view as to where digital assets infrastructure fit into kind of their book of existing investments. But two, also look at the trends behind the ebbs and flows of retail participation in this space. We open up this year with really speculation being back in vogue. Just rewinding clock back, retail has shown significant signs of life, especially driven by Asia. So in liquid side of the market, we have seen a number of AI coins, casino coins, low liquidity, very thinly traded volatility coins take a lion's share of participants in the market. Now, what has happened in the illiquid side of the market is that we have witnessed a valuation re-rate. Valuation re-rate that we'll talk about it here in a second. Last year has been primarily driven by two events. Implosion of Terra Luna ecosystem was the first one, and of course, FTX saga starting November was the second one. Now we have a third event that just has happened 2 weeks ago that we're still all processing and reacting to, and that has been the rapid debanking of a lot of US projects and startups. What that meant, a lot of the valuations have been getting depressed or essentially re-rating in reaction and in direct response to the behavior that we have seen from investors that are starting to kind of hedge their bets and be extremely sensitive to the entry point on the valuation spectrum.
Yep, a lot to unpack there, my friend. A lot to unpack there. One of the things I always love, and see if maybe we can put a grab of this when we put this out, is there was a great chart from Union Square Ventures, a prolific VC for the last 20, 30 years. Fred Wilson, the team over there, fantastic. Nick Grossman, a few years ago, posted this, and I remember this when I was starting to dabble in the world of digital assets, is the infrastructure phase. Call it the myth of the infrastructure phase, but for all intents and purposes, we'll just talk about it, the infrastructure phase. And so it goes back all the way to the 70s, where you had messaging and email in 1970, 1972, supported by infrastructure. Later on after that with Ethernet, TCP/IP, had ISPs. Then in the 90s, you had things like AOL, but AOL was needed to have more infrastructure in terms of things like Mosaic, which became Netscape, Lycos and Activista, AltaVista, and Google Search. So being able to find things on the internet. And then you go further and further down the road until, apps like Uber and FanDuel and Instagram and Snapchat that needed infrastructure like MongoDB and OpenSSL and Stripe and Cloudflare. So it's a give and take. You build something amazing, you build a few things amazing, and then all of a sudden you realize you need to have the infrastructure to support it. So getting back to kind of where we were seeing a lot of that capital flow, I think it makes absolute perfect sense that we've gotten to a point where there is interest. We have millions of people around the world that have digital assets and wallets. We've seen the rise of things like Axie Infinity as a game in the space that have gotten 3 million daily active users. And then we've seen that there have been some issues with that from an infrastructure and economic and tokenomics level. And so this is a give and take. And this is very normal in the evolution of technology and the adoption of technology. And so that's really, I think, one point I wanted to nestle up onto that one. In terms of what you're talking about, in terms of valuations, in terms of durations, yes, it makes absolute sense. What we're seeing across the board is that, from a regulatory clarity perspective, we don't really have a lot of regulatory clarity here in the United States. We've been asking for it for years, and we continue to ask for it. But what's happening is that you have a lot of the founders who want to decentralize, who want to have distributed networks, but they need to have that vis-a-vis some sort of a token that they can provide that to those that are participating in the network. That's also very supportive of bringing people up into society, bringing people up economically, letting them participate in these networks. We haven't been able to see that before with, Uber and Airbnb, where they've been doing the work of the network, but they don't really have the economic upside of that company or that project. And so we can't really do that a lot here because we don't have the clarity as in terms of what the regulators think. Is it a security? Is it not a security? How does it become decentralized? And so there's so many things in flux right now. And so in terms of, the regulatory issues that Michal alluded to, we're also seeing, very significant interest in things that are happening in Europe with MiCA, where you're seeing the regulatory framework for the European Parliament take the last few years of work, inspection, and discovery, and try to come up with regulatory patterns that make sense for growth of the industry. And so we're seeing that, but that's not going to happen. They're going to vote on that, and it's going to happen hopefully in April of this year. But, it's going to take some time for that to become manifested, to really become the law of the land, to become workable. So you have that as an issue. And so you have so many of these things happening. Yeah.
With a very significant implications and knock-on effect as to how investors are thinking of kind of positioning themselves. And more importantly, in our world, how are the founders reacting in response to some of these potentially new, restrictive, but nevertheless frameworks that you can reference in your build and design of your product and offering. One element in relation to what you've just mentioned, David, that jumps out at me is for as long as I can remember being involved in this space, Europe has never been seen as the bastion of hope for this industry. It was historically a little bit of the opposite, and if anything, it has been more of a laggard and a follower to the pace set by the founders and projects out of the US, and dare I say, some of the regulators that were perhaps a little bit more progressive. Now, there is certainly a wind of change, and that is very unfortunate for being particularly US based and wanting to run your business out of an onshore entity here in America, given the environment that you are thrown into today. One where, not only you're struggling to position yourselves operationally with banks shuttering or outright sending you cashier's checks in mail, one way, signifying kind of that one-way relationship. But more importantly, how do you ultimately envision not only bringing your product to the market, but then ultimately seeing an active engagement from retail with your product, or even other institutions that are also very much responsive to that framework. So what David has been referring to as the new regulatory framework is called the Markets in Crypto Assets, the acronym of MiCA framework coming in Europe. That is getting voted on by the European Parliament next month. Now, the timeline here is also very important. The moment this gets voted into a law and gets promulgated within a 30-day window post the vote, it will take time before it will become law. So just to give you an example, there are several elements in that bill that relate to stablecoins as well as other digital assets. The stablecoin piece of regulation actually comes out 12 months after the promulgation of that bill into law. Now, with reference to the other elements of that bill, classification of digital asset, standards for your white paper issuance, or any token issuance in the market, those will become standard in 18 months from now. So really looking firmly at a Q4 of 2024. But a time to essentially position yourselves and have an opinion, I would argue, is now. And this is something we're ultimately urging both of our founders, as well as our fellow investors, to get up the curve and understand the ramifications of this new world order coming out of Europe.
I agree. There's, again, a lot of things in flux. There's a lot of really important pieces that are being put out there. We've seen other countries around the world, like Hong Kong, saying that they're going to open their doors to the world of digital assets. We've seen a significant influx of interest in Latin America. And so as we are in this pause period right now of the United States trying to figure its way going forward, whether that is more restrictive or not, it is having a cascading effect on valuations here, as you alluded to. It's also having a cascading effect on duration. So whereas deals were closing in 2 to 3 weeks in prior periods that we've looked at, deals are now taking 4, 6, 7 weeks, and even more. And so you see that reflected in the numbers that we alluded to at the beginning, is that, whereas this time last year, there was almost 550 deals done, there was, just about 240 deals done this time. And so you're definitely seeing slower pace. You're seeing much more attention to the regulatory frameworks and to detail there. And that's all having as you said, Michal, affect the valuation schema. Why don't we take a look at what are some of the trends and kind of the themes that we're seeing in terms of the sector and the space? Where do we see some things that are happening here that are very interesting? I'll start off, and then Michal, would love to hear kind of some of your thoughts on things like real world assets. One of the things that we've been looking at are the exploration of NFTs on Bitcoin. This was brought to the world around January of this year. Casey Rodamore, a very intelligent, brilliant developer, was able to look at some of the innovations within Bitcoin that's happened over the last year. There's been some improvements called Taproot and a few others out there that have given Bitcoin the ability to do things similar to what we've seen with Ethereum and some of the other chains out there. And so fast forward, you have now an entire theory book that Casey was able to design And with that, you're able to inscribe metadata. That could be a picture, that could be even something like a scientific discovery, if you can even imagine that, onto a Satoshi, which is obviously the smaller parts of Bitcoin. And so this is really interesting. We think that this has got some legs to it, and we are definitely looking to see further build out in that space. Michal, to you.
I would say the other theme that certainly is going to be a big part of focus for us going forward for the remainder of the year here is certainly looking at real world assets as a new source of that real yield that many have talked about. Very few have actually accomplished and started pushing onto the mass user base. What RWAs for short stand for and are loosely defined really as tangible and financial assets with kind of the potential to serve as that collateral that many of the DeFi primitives that we know and love can use today. And so some of those popular examples that often get put into that basket include anything from credit notes, corporate debt, real estate, stream of royalties and invoices, anything that could become a linchpin, and it already is a linchpin for yield generation in the TradFi world, now slowly but surely migrating on chain, posing its own set of challenges, but nevertheless, one of the developments that we find extremely welcome and particularly exciting. The space that right now we have our eyes very firmly on is looking specifically at the private debt. Private debt issuance is essentially non-government debt issued to the market. This is a rather small market when you're looking at the 100+ trillion of the world of financial assets, today representing about $1.4 trillion. But nevertheless, one area where we are finding an early semblance of a product market fit for what is able to happen for many of the fintechs, as well as the emerging markets credit note issuers. They are now able to not only tokenize that particular instrument, but find like a broader subset of potential backers and investors that is not captive to their given jurisdiction, whether it's sub-Saharan Africa, Latin America, but now opens it up to a wider pool of investors here in the US, Europe, and Asia. And the tooling still very early days, but the kind of work that's being done by projects and founders that we're talking to these days is extremely promising, and one that we think will be able to unlock a brand new, not so brand new, we always love to call it brand new in this space, but essentially an asset class that is very well established, has a good following, and bring it to an on-chain environment where it can benefit from some of the primitives that on-chain and public networks bring to bear. So very excited about that as a trend.
There's also a lot more for us to be talking about. There's other themes out there. The NFT is the new internet cookie, security that's happening in the space, but that's for another show, and hopefully you can join us again. So thank you all. Again, this is Connecting Nodes. We'll be back to you real soon with more information, more trends, more valuation information. Try to get you a little bit more smart about what's happening in the world of digital assets from the venture perspective, and we'll see you soon.
Thank you all.